The air in the boardroom is thick enough to drill through. You've got a dozen executives in expensive suits all staring at a PowerPoint slide like it holds the winning lottery numbers. On one side of the table, you have the engineers, the geologists, the rock stars, literally. They're buzzing, talking about prolific reservoirs and high-quality crude. They found a massive pool of oil buried under the ocean floor, somewhere off the coast of a country you can't pronounce. They're practically high-fiving each other, convinced they've hit the jackpot. This is the moment they live for, the thrill of discovery, the promise of a gusher that could power cities and make the company a fortune. They see pure black gold. On the other side, you have the finance team. These are the people who see spreadsheets when they close their eyes. They aren't nearly as excited. In fact, they look like they just found out their favorite coffee shop is switching to decaf. They're frowning, tapping their calculators, and muttering about discount rates and fiscal regimes. One of them, a stern-looking woman named Brenda who probably calculates the interest on her grocery bill, points a laser at the screen. "The geology is great," she says, her voice flat, but the numbers tell a different story. Suddenly, all that excitement in the room just deflates like a bouncy castle with a slow leak. This, my friends, is where the magic or the heartbreak of petroleum economics happens. It's the ultimate reality check. Finding oil is the easy part. Well, not easy, you still have to find it. But the real challenge, the billion-dollar question that keeps everyone up at night, is this. Does it actually make financial sense to get that oil out of the ground? It's a high-stakes game of poker where the buy-in is billions of dollars. The game can last for 30 years, and you don't know what cards the world is going to deal you. Will prices go up? Will they crash? Will the government change the rules halfway through? The engineers might see a giant underground lake of oil, but the economists see a giant pile of cash that needs to be spent today in the hope of getting even more cash back, spread out over the next few decades. And that is a completely different ballgame. It's the difference between finding a treasure map and actually having the treasure in your hands. The map is exciting, sure, but it's the journey, full of costs, risks, and taxes, that determines whether you end up rich or just with a very expensive, very deep hole in the ocean. This is the world of petroleum economics, where dreams meet balance sheets, and only the most profitable survive. So, how do Brenda and her team of number crunchers decide if this whole adventure is worth it? They don't just flip a coin, they have a set of tools, a sort of financial crystal ball, to help them peer into the future. These are the big 5 metrics that every oil executive needs to understand. First up is the big boss, the heavyweight champion, the net present value, or NPV. This one is all about a simple truth. Money today is worth more than money tomorrow. NPV takes all the money you expect to make from the project over its entire life, discounts it to what it would be worth in today's money, and then subtracts the massive cost of getting started. If the number is positive, congratulations, you're making money. If it's negative, you're basically lighting a giant pile of cash on fire. Next, you have the cool cousin of NPV, the internal rate of return, or IRR. The IRR is the project's own personal interest rate. It's the exact discount rate at which the project breaks even, where the NPV is 0. Think of it like this. If your bank offers you a 5% interest rate on your savings, but your oil project has an IRR of 15%, you're probably going to go with the oil project. It's a way of comparing different investment opportunities. A higher IRR means your money is working harder for you, which is always a good thing. It's the project's performance score, a single percentage that tells you how powerful its profit-generating engine is. Then there's the one everyone can understand, the payback period. This is the financial equivalent of asking, are we there yet? On a long road trip. It simply tells you how many years it will take to get your initial investment back. If you spend $2 billion on a project and it starts making you $500 million a year, your payback period is 4 years. Companies love this one because it's simple and it measures risk. A shorter payback period means you get your money back faster, reducing the time you're exposed to things going horribly wrong, like a sudden price crash or a political crisis. It's the get my money back quick metric. Finally, we have 2 more useful sidekicks. The profitability index, or PI, is a simple ratio. It takes the present value of all your future cash flows and divides it by your initial investment. If the PI is greater than 1, your project is profitable. A PI of 1.5 means that for every dollar you invest, you get $1.50 back in today's money. It's a great way to rank projects when you have limited capital. And last but not least, the break-even price. This is the minimum oil price you need for your project to not lose money. If your break-even price is $40 per barrel and the current market price is $80, you're happy. If the price drops to $35, you're officially in the losing business. It's your project's survival threshold. At the heart of all those fancy metrics is something much simpler: cash flow. This is the lifeblood of any project. It's the story of money coming in and money going out year after year for the entire life of the oil field. To figure this out, you need to build a model, which sounds complicated but is really just a very detailed story about the future told in numbers. The first chapter of this story is about revenue, the money coming in. This is the easy part to dream about. You just multiply the amount of oil you plan to produce each year by the price you expect to sell it for. Simple, right? Except you have to guess the price of oil for the next 30 years, which is like trying to predict the weather in London from a moving car in another country. But the good times don't last, because right after revenue comes the villain of our story: costs. And oh boy, are there costs. First you have the capital expenditures, or CAPEX. This is the enormous upfront payment to get the party started. It's the money for building the giant offshore platforms, drilling the wells, laying the pipelines, basically all the expensive hardware. We're talking billions of dollars before you've even seen a single drop of oil. It's like buying the world's most expensive Lego set, and you have to pay for it all at once. This is the massive negative cash flow at the start of the project that gives finance people nightmares. Once the oil starts flowing, the spending doesn't stop. Now you have to deal with operating expenditures, or OPEX. These are the day-to-day costs of keeping the operation running. Think of it as the project's monthly utility bill. It includes the salaries for all the workers on the rig, the fuel to power the equipment, maintenance to fix things that break, insurance, logistics, the list goes on and on. While not as big as the initial CAPEX, OPEX is a constant drain on your cash flow every single year. It's the slow, steady drip that can sink a project if you don't keep it under control. And just when you think you're done, guess who shows up with their hand out? The government. The final, and often largest deduction from your cash flow is the government take. This includes royalties, which is a percentage of the revenue you have to pay right off the top, and corporate income taxes on your profits. Depending on the country and the contract, this can be a huge chunk of your earnings. It's like having a business partner who doesn't put in any money, but is legally entitled to half your profits. So, your final cash flow for the year is your revenue, minus your operating costs, minus your taxes. This is the number that really matters. Let's make this real. Imagine we're a company called Trevor's Tremendous Oil, and we found a small oil field. We'll call it the Funny Bone Field. Our engineers tell us we can get it up and running in 1 year. To do this, we need to spend $100 million right now, in year 0. That's our CAPEX. This is a huge negative cash flow, minus $100 million. Our bank account is already crying, but we're brave, and we push forward because our geologists promise us that, starting next year, this field will produce oil for 3 years straight. This is a very short project, but hey, we're keeping it simple. Now let's talk about the good stuff, the revenue. Our team estimates we can produce enough oil to generate $60 million in revenue each year for 3 years, year 1, year 2, and year 3. We're assuming the oil price stays nice and stable, which in the real world is a hilarious joke, but for our story, let's go with it. Of course, it costs money to keep the pumps running. Our operating costs, or OPEX, are projected to be $10 million per year. So, our gross profit each year, before the taxman comes knocking, is $60 million in revenue, minus $10 million in costs, which equals a neat $50 million. But we live in a society, and that means taxes. Let's say the government in the land of Funny Bone Field has a simple 40% tax on profits. So each year we take our $50 million profit and give 40% of it to the government. That's $20 million. It hurts, but it's the cost of doing business. This leaves us with a net cash flow of $30 million each year for years 1, 2, and 3. So, to recap our little financial story, we spend $100 million today, and in return we get $30 million next year, $30 million the year after that, and $30 million in the final year. The big question is, was it a good deal? This is where our financial tools come into play. We have an initial investment of $100 million and a stream of future income. Just adding it up, we get $90 million back, which looks like a $10 million loss. But wait, we forgot about the time value of money. That $30 million we get in 3 years isn't worth $30 million today. We need to discount those future cash flows to see what they're really worth. Once we do that, we can calculate our NPV and IRR and find our payback period. This simple model, this story of money out and money in, is the foundation for every single investment decision in the entire oil and gas industry. Now we get to the part that honestly separates the pros from the amateurs, understanding that the future is messy and unpredictable. The first rule of petroleum economics is that a dollar today is better than a dollar tomorrow. This is the time value of money. Why? Well, because a dollar today can be invested to earn interest, making it grow into more than a dollar by tomorrow. Or, to put it another way, inflation will make that future dollar buy less stuff. So, when we look at the $30 million we're getting in 3 years from our funny bone field, we have to discount it back to its present value. Using a standard discount rate, say 10%, that $30 million in year 3 is only worth about $22.5 million in today's money. It's kind of like looking at a distant object through binoculars. The further away it is, the smaller it appears. This is why NPV is such a powerful tool. It forces you to acknowledge this fundamental truth. But the big question is, what discount rate should you use? This rate represents the risk of the project and the return you could get from other safer investments. A risky project in an unstable country will require a much higher discount rate than a safe project in, say, Norway. Choosing the right discount rate is one of the most debated topics in any boardroom. Get it wrong, and you could either approve a terrible project or reject a golden opportunity. It's part art, part science, and all pressure. The second massive headache is uncertainty, and the biggest uncertainty of all is the oil price. Our simple model assumed a flat price, but in reality the oil price is more volatile than a toddler who missed their nap. It can swing wildly based on global supply, demand, geopolitical conflicts, or even a tweet from the right or wrong person. So what do companies do? They perform a sensitivity analysis. This is the fancy term for playing the what-if game. What if the oil price is $10 higher than we thought? What if it's $20 lower? How does that change our NPV? What happens to our break-even price? You don't just do this for price, you do it for everything. What if our drilling costs are 20% higher than expected? What if the reservoir contains less oil, and our production is 15% lower? By running dozens of these scenarios, you can see which variables have the biggest impact on your project's profitability. This creates a tornado chart, which shows you your biggest risks. If a small change in price completely destroys your project's value, you know you're walking on a financial tightrope. This analysis doesn't give you a perfect answer, but it shows you the range of possible outcomes and helps you understand just how much risk you're taking on. Just when you think you've figured out your project's economics, you have to remember your most important partner, the government of the host country. They own the resources under the ground, and they have a lot to say about how much of the profit you get to keep. The rules of the game are set in a legal agreement, and there are a few different flavors. The oldest and simplest is the concessionary system or tax and royalty system. Here, the company owns the oil it produces but has to pay the government a royalty, a percentage of revenue, and a corporate income tax on its profits. It's relatively straightforward, like paying rent and taxes on a property you control. However, most countries today prefer a different model, the production sharing contract, or PSC. This sounds friendly, like everyone is sharing, right? Well, it's a bit more complicated. Under a PSC, the government officially retains ownership of the oil. The oil company acts as a contractor, investing its own money to find and produce the oil. In return, the company gets to recover its costs from a portion of the oil produced. This is called cost oil. Whatever is left over after that is profit oil, which is then split between the company and the government according to a pre-agreed formula. This split can be tricky. Sometimes it's a fixed percentage, and sometimes it changes based on how profitable the project is. The details of these contracts are everything. They determine how quickly you can recover your initial investment and what your ultimate share of the profits will be. A government might, for example, put a cap on how much cost you can recover each year, which slows down your payback period. They might also implement a sliding scale for the profit oil split, where the government's share gets progressively larger as the price of oil goes up, or as the project becomes more profitable. This is designed to ensure the country gets a bigger piece of the pie during boom times, which sounds fair, but it also reduces the upside for the company. The total amount of money that ends up in the government's pocket through royalties, profit splits, and various taxes is called the government take. For a company, minimizing this take, legally of course, is a key objective. For a government, maximizing it is the goal. This creates a natural tension. Companies will favor countries with stable, attractive fiscal regimes, the overall system of contracts and taxes. A country that suddenly changes the rules of the game, increasing taxes or altering the PSC terms after a company has already invested billions, is committing fiscal instability. This is a huge red flag for investors and can scare away future investment for decades. After all the modeling, the sensitivity analysis, and the contract negotiations, the moment of truth arrives. The executives have to look at the final numbers and make a decision, go or no go. So what makes a good project? It's not about a single magic number. Instead, it's about a project that looks robust from multiple angles. First and foremost, a strong project must have a positive and significant NPV. Significant is the key word here. If you're investing $5 billion, an NPV of $1 million is not going to get anyone excited. The potential reward needs to be worth the massive risk and capital you're tying up for years. Next, a healthy IRR is critical. Companies usually have a minimum acceptable rate of return, often called a hurdle rate, which might be something like 15%. Your project's IRR must be comfortably above this hurdle. A high IRR not only indicates a profitable venture, but also provides a buffer. If costs end up being higher or prices lower than expected, a project with a 30% IRR has a much better chance of staying profitable than one with a 16% IRR. It's like having extra padding for when things go wrong, which they often do. A good project should feel financially strong, not just barely scraping by. But smart companies don't just look at the upside, they are obsessed with the downside. That's where the payback period and break-even price come in. A project with a quick payback period, say under 5 years, is highly attractive because it returns the initial capital quickly, reducing the window of risk. And a low break-even price is perhaps the most important indicator of a project's resilience. A project that can make money even when oil is at $30 per barrel is a fortress. It can survive the brutal price cycles of the industry. A project that needs $70 per barrel to break even is fragile and could easily be wiped out by a market downturn. The biggest pitfall in all of this is falling in love with the geology, what they call resource romance. The engineers might be thrilled about the sheer size of the discovery, but if the economics don't work, it's just expensive, inaccessible rock juice. Another common mistake is being overly optimistic. Using a consistently high oil price forecast in your model is a recipe for disaster. The best practice is to use a conservative price deck and to stress test the project against a low price scenario. A good investment isn't just one that looks great in the best-case scenario, it's one that still looks acceptable in the worst-case scenario. For decades, the questions in the boardroom were mostly about price, cost, and geology. But today there's a new set of questions, and they are shaking the very foundations of the industry. The giant gas-guzzling elephant in the room is the energy transition. The world is slowly but surely moving to combat climate change, which means reducing its reliance on fossil fuels like oil and gas. This isn't some far-off hypothetical problem anymore, it's a strategic risk that has to be factored into every single investment decision. A project that starts today might still be producing oil in 2050, but what will the world look like then? This introduces a whole new layer of uncertainty, which we can call demand risk. In the past, oil companies could generally assume that global demand for their product would keep growing. That is no longer a safe assumption. As electric vehicles become more popular, demand for gasoline will fall. As renewable energy sources like solar and wind become cheaper, demand for natural gas to generate electricity might plateau or decline. So the new question is not just what will the price of oil be, but will anyone even want our oil in 20 years? This is a terrifying thought for an industry built on long-term investments. This changing landscape is already affecting how companies choose their projects. There's a growing preference for projects with a short cycle and a low break-even price. Short-cycle projects like shale oil in the United States can be developed quickly and have a fast payback period. This means companies can get their money back before the world changes too dramatically. They don't want to be stuck with a 30-year mega project that might become a stranded asset, an asset that is no longer able to earn an economic return because of new climate policies or a permanent drop in demand. Resilience is the new name of the game. Furthermore, investors and banks are putting on the pressure. They are increasingly asking tough questions about a company's carbon footprint and its strategy for the energy transition. Some are even refusing to finance projects that are seen as too polluting, like those involving oil sands. This means the cost of capital for fossil fuel projects could go up, making it harder to get them financed. Companies are now having to model the potential cost of carbon taxes or emissions trading schemes, adding another line item to their cash flow models. The game is changing, and the companies that fail to adapt their economic thinking to this new reality are the ones that will be left behind. So we've journeyed through the complex, high-stakes world of petroleum economics. We've seen how a flicker of geological hope is transformed into a cold, hard set of numbers. We've learned that NPV is king, a high IRR is your best friend, and a low break-even price is your shield against the chaos of the market. We've seen how cash flow is built from the ground up, torn down by costs and taxes, and then re-evaluated through the unforgiving lens of time and risk. It's a world where a misplaced decimal point in a spreadsheet can mean the difference between a billion-dollar success and a billion-dollar failure. The core job of an oil and gas manager is to be a master of capital allocation, to place the company's bets on the projects that offer the best possible returns for the risks taken. To do this, they must constantly ask the right questions. It starts with the basics. Is the NPV strongly positive at a conservative price? Is the IRR well above our hurdle rate? Can we get our money back quickly? Is the break-even price low enough to survive a storm? These are the timeless questions of the industry, the bedrock of any sound investment decision. They are the gatekeepers that prevent bad projects from ever seeing the light of day. But the questioning can't stop there. The world is evolving, and so must the questions. Managers now have to ask, how does this project fit into a world that is actively trying to use less of our product? What is our exposure to a sudden shift in government climate policy? Could a carbon tax turn this profitable project into a loser overnight? Are we investing in a resilient asset that will be valuable for decades, or are we building a future museum piece? These are not easy questions, and they don't have simple numerical answers. They require foresight, strategic thinking, and a healthy dose of humility about our ability to predict the future. Ultimately, the best investment decision is one that is robust, resilient, and responsible. It needs to be financially robust enough to withstand market volatility. It needs to be strategically resilient enough to navigate the massive uncertainties of the energy transition. And increasingly, it needs to be seen as responsible by a world that is demanding cleaner energy. The executives in that boardroom staring at their PowerPoint are no longer just deciding on a single project. They are making a statement about their company's view of the future, and placing a bet on their ability to thrive in it. And that, more than anything, is a decision worth losing sleep over.